Hey everyone, welcome back. Ready for another deep dive?
Definitely.
So it's this English learning podcast called Daily Money Briefing.
Huh. Interesting. Okay.
It's actually pretty cool. You get the
Yeah.
financial news and kind of a language lesson all in one.
Oh, I like that. Sort of killing two birds with one stone.
Exactly. Okay, so today we're digging into a few financial headlines.
We've got interest rates in South Korea and the U.S., and then that really significant drop in the Japanese yen.
Exactly.
Yeah.
Three different things, but let's see how they connect.
Yeah, they might seem separate, but I think they weave together a pretty compelling story about what's happening right now.
South Korea first then. They've kept their main interest rate steady, 3.50%. That's the ninth time in a row, right?
Ninth time, yeah. It's a long hold.
So what's driving that consistency?
Well, the reports really point towards domestic stability being the key. They seem worried about, weak consumer spending.
Okay.
And also growing household debt. That's a big one for them. So they're cautious. They don't want to lower rates and maybe spark more inflation or make that debt situation worse.
Right. So it's like they're managing internal pressures first, not necessarily pushing hard for growth right this second.
Exactly. It suggests, for their immediate outlook, it's more about handling these vulnerabilities they see at home. A cautious approach.
Okay. That makes sense. Now, let's shift over to the U.S. We saw tech stocks take a bit of a tumble. What happened there?
Yeah, that seemed directly linked to the latest Federal Reserve minutes.
The Fed minutes. They always seem to move the market somehow.
They really do. And this time, the minutes hinted that U.S. interest rates might need to stay higher for longer.
Higher for longer. Okay, and why does that specifically hit tech stocks more than others?
Well, a lot of tech valuation is based on, future growth and future profits. When interest rates look like they'll stay high.
It makes borrowing more expensive and future money less valuable today.
Precisely. Higher rates can increase their costs, and crucially, it discounts the value of those future earnings people are banking on. So investor hopes for rate cuts faded a bit.
Got it. And we saw big names affected.
Oh, yeah. Apple, Google, Tesla, they all felt that shift in expectations. It signals maybe a bit more caution around tech investment for now, and potentially affects the broader U.S. economy, too.
Okay, so Fed expectations hitting tech. Now let's jump across the Pacific to Japan. The yen. Wow. Lowest level against the dollar in, 34 years?
Yeah, it's a really big move. Trading near 160 yen per dollar. That hasn't happened since 1990.
That's huge. And it raises talk of government intervention.
Exactly. Currency intervention. There's definitely chatter about whether the Japanese government or the central bank might step in.
And intervention just means they'd buy yen to try and push the price back up.
That's the basic idea, yes. Buying your own currency to strengthen it or selling it to weaken it. Here it would be buying yen. But it's risky.
Risky how?
Well, it costs a lot of foreign reserves, and it doesn't always work long term if the underlying economic pressures are still there. The market's watching very, very closely.
And the implications. I mean, a weak yen helps exporters, right? But intervention adds uncertainty.
You got it. Cheaper yen means Japanese goods are cheaper abroad. But intervention itself can make currency markets volatile. It really highlights how these things ripple out globally, affecting trade and investment flows.
Okay, so let's tie this together. We have South Korea being cautious, U.S. tech reacting to rate hike fears, Japan grappling with a super weak yen. What's the common theme you see?
I think the big picture is just how tricky things are for central banks everywhere right now. It's a real balancing act.
Balancing inflation, debt, growth.
Exactly. They're all trying to manage inflation, support growth without overheating, handle their own specific domestic issues like debt or weak spending, and react to what's happening globally. It's complex.
It really shows these aren't just isolated headlines, are they? They're all interconnected pieces of this global economic puzzle.
Absolutely. And these policy decisions, these market reactions, they have real impacts, for businesses, for individuals, for the whole global system.
Definitely gives us a lot to track. So just as we wrap up.
We encourage to see how they unfold.
Indeed.